And we are live. Welcome to Oz Property Investors, where we have the big names and we have the big fun. Guys, this is going to be an interesting one. I feel like over the past couple of months, the property market has fundamentally shifted. We've got people not being able to afford fuel. Some guy was filling up $20 worth of fuel and he got 6 liters. And people are starting to question this whole property game. It's like it takes weeks to shake confidence. So we have Joey Diagata, sorry, mate, and Steve.
That's not us, right, Steve?
I'm frozen. Joe's frozen. There we go. Joe's frozen. I'll take over. And we've got Steve Felici.
Oh, he's back. He's back.
You go.
Sorry,
you go,
Joey,
mate. I feel like you had some momentum there.
No. All right. Joe's freezing, so I'm taking over today, guys. We've got Steve Felici, the bearded investor, and we're going to be talking all things property strategy. Joey looks after Game Plans, which is literally the biggest property strategy software. And we're going to see real life client scenarios of different salaries of what's actually achievable in like 100 grand, 200 grand. And even at the end, I think we're going to go through Joey, like someone who's done something similar to me, big resi portfolio, sold up and transitioned to commercial. So we're actually going to see real case scenarios, not the fluffy buyer's agent story ones me and Joe tell about, like, we've got a Coles worker who earns a 12 mil portfolio. Like, we'll actually see real portfolio's.
Yeah, that's it.
Well, that's
part of what we're looking at uncover today.
Well, that's what kind of excited me about this was like, okay, cool. Well, because I mean, we're guilty of it as well. We bring on people that have like $20 million, $30 million property portfolios. And then they've got some business behind it or some backing, but instead we're just going to look at, okay, cool. Joe, like, everyone knows that 92% of investors own, was it 1 or 2 properties or something like that? There's that stat thrown away from a ABS from all those years ago. Today is all about, Joey, you've got a platform, Game Plans, that has over 10,000, I think it's 11,000 property strategies. So those are people that are deliberate like property investors. So what are the top 1% of those people doing? So it's like it's the top 1% of the top 1%. And we didn't want to make it so it's boring and like, okay, cool. Well, yeah, he has $500,000. Of course he's doing well. So we're going to break it down to people that have $100,000. And we got 2 people that are breaking down $100,000. What else have we got, Joey? What else do people expect?
I think, Joe, one of the points is like, you always see the news stories about the people with these portfolios, but it never really gives like how many properties, their value, what income there is, like what taxes they're paying, like how they're structuring. Like, because we're making this effectively anonymous, we actually get to see real people's portfolios.
Yeah.
And so what I'm going to do is I'm going to run through what I've got our kind of top one, like our number 1 user that's earning 100K. And so we'll go through their portfolio. And then I've also added in another one who's just a property portfolio that's struck out at me, another 100K income earner. So we'll have a look at a couple of 100K income earners. Then we're going to jump up the income brackets and we'll have a look at a 250K income earner. Again, this is the top 250K income earner. So it's the best portfolio that we have on the platform for someone earning that income. And then we're also going to jump up to that upper echelon and have a look at a 500K income and what their property portfolio looks like. And just yesterday, we had our someone that's entered in 43 properties. So they've only just signed up to the platform, 43 properties. I haven't had a chance to validate all the numbers in there just yet, but the portfolio size was eye-watering, north of $20 million.
Wow.
That's like,
incredible.
That's still a lot of properties for a 20 mil portfolio.
You're right. It's a whole bunch. It's a whole bunch of resi assets. And if you divide that, you can kind of see that the average price is circa 500K.
Probably one of the buyer's agents who lies about having 100 properties and that's a real portfolio.
This person's not a buyer's agent. I can confirm that, but they are a very successful business owner.
Just took a screenshot to post it on the socials. Yeah. Game Plan says I have this. Speaking of Game Plans, so Joey Diagata is Game Plan's head of strategy. So he is the man, together with Jordan DeYoung, pretty much help build the platform that is Game Plans. And we're not trying to sell Game Plans. You can't even get access to it. It's actually what we use as buyer's agents internally to map out and chart kind of where you are right now, where you're looking to go, and how do we reverse engineer to build that strategy? Because, just because you want to retire on $500,000, you may not have the income to support it. We may not have the capital to support it. So how can we get to here in the quickest amount of time possible with what we're actually playing with. So Joey, you've done thousands of property strategies and broken them down based on what real people are doing. So that's a bit of an introduction to yourself. You've been doing this for a very long time, successful investor as well. Anything else, guys?
I'd like to touch on that stat, the ABS stat that you hear thrown around as well. It's probably a good way to kick things off on the chat this evening. That the stat thrown around is that, like, I don't know what it is exactly, but X amount of property investors only earn. You're in the top 1% of property investors if you own 5 or more properties. But you could own 5 $100,000 assets, so your total portfolio size is worth 500,000. Does that then put you in the top 1% of property investors? Probably not. So what we've done, and we actually ran this report about 24 months ago, and then we've run it again a couple of months ago. We've actually surveyed our users, and we're actually going to go, well, what actually puts you in the top 1% of the top 1%, like you've mentioned there. And it's actually a portfolio value of 11.7 million. So close enough to $12 million. That's the top 1% of property investor, not someone who owns 5 properties. Because to Steve's point there, you could have sold down a whole bunch of resi assets and controlled one large commercial property. And that, spoiler alert, that's something that we're also going to show you one of our users on the platform today as well. So that's actually our top 1%. And an interesting takeaway is that our median portfolio size is 1.5 mil. And something interesting to note is that's actually increased from 24 months ago, where the median price was 1.3 mil. So a 200K increase over 24 months.
I think your platform as well is people who are actively trying to build portfolios as well, because like they're typically the ones that like go to a buyer's agent, and most buyer's agents using the platform are like aggressive buyer's agents. They're not just like my dad who paid off most of his house and was like, oh, I'll buy an apartment in Foster so I can go on holidays, and that's kind of it.
Yeah, exactly right. Exactly right. And also at the same time as well, like we definitely don't want to discredit that it is a hard slog, and like it's not an easy feat. And so that's why, and the numbers speak to it as well. Like the vast majority of the users on the platform have portfolio sizes of so 33% have portfolio sizes up to $1 million. So if you kind of group them in categories, that's where the vast majority, the biggest cohorts sit in the sub $1 million range. So we definitely don't want to say that this is easy, but we are going to kind of peek behind the curtains and reveal some really interesting data behind some of our sophisticated investors.
Spicy.
Can I ask some questions just generally about strategy? Because like you've done so many one-on-one strategies. Is there any like misconceptions or any surprising things you find when you're doing the strategy? Because like I found when I've done them myself, normally people overestimate what they can do in 2 years, but vastly underestimate what they can do in 15, 20s. But is there any like typical common themes you see when you're doing strategies, what people expect?
That's a really common one. And people get really surprised that compounding is a real thing. And when you kind of compound a number year on year on year on year, and after 20 years, for example, the property valuations can be pretty eye-watering, as can the rental income. People like being looking at it and go, well, how can the rental income seriously of my portfolio go to $185,000? And we're like, well, look back. And funny enough, I had a podcast with a seasoned investor not that long ago about, he's been investing for over 5 decades. His first property that he bought, he was getting $12 a week rent. And now that same property is renting for $1,500 a week. So you can just see, and I always kind of point that out. So people, and you are right, people go, well, why can't I do more now? And then at the same time go, well, those numbers there just don't simply stack up in 20, 25 years time. And we're actually showing you, well, we're not making anything up here. This is just a number compounding year on year on year on year on year in the platform. We haven't come in and done anything to amend that. I think the number one thing that kind of would get most investors, and I'd say this is no surprise to anyone, it's probably going to be borrowing capacity as the number one thing. And that's probably what most people, not most people, but a lot of investors who maybe aren't necessarily well informed, haven't had those conversations with their buyers agents, haven't had those conversations with their mortgage brokers, kind of get into investing and then go, oh, wow, I've already bought a property and I didn't realize that actually has ramifications in terms of what I can do next to that next acquisition, because borrowing capacity is a real thing.
Yeah. Is that one of the main advantages of game plans then? Is just like it obviously brings that stuff to the surface as opposed to just the sky, or?
Yeah, I mean, you can just if I had this before I started buying my first few properties, I probably would have made some of the acquisitions that I had done, just coming willy-nilly buying properties because I could, until such time as the broker taps you on the shoulder saying, hey, you can't actually go out there and do that. For me, it'd be more around coming through and stress testing these what-if scenarios before you actually committed the dollars towards making the acquisition, because we all know that property transaction costs are pretty heavy, 6% to get in, 3% on the way out, like 10% in fees caught up just in the transaction costs. So actually coming through and running some different scenarios before you actually push go on the acquisition, so that you can stress test the numbers and make sure that you can hold the thing and it actually is getting you close to your end goal.
One of the things I want to kind of promote is we've got a whole bunch of people on here. So I want to promote questions. So there's going to be a lot of data. There's going to be a lot of information. So I want to make sure that we connect it and ground it to the reality of like the normal investor, which we're going to do with the multiple scenarios. But any questions that you guys have, throw them in the comments. We'll talk to them. A great member of the community, Jeff Miles, has jumped in here. He said, I'd love to hear Joey's thoughts on building a 3 to 5 property portfolio starting today. I think it's doable. It won't be magic overnight, but doable. How do you feel about this? I mean,
wait. More importantly, is Jeff a 96 baby?
No. 82,
Oh,
96. Is he 82? Right, maybe he's a bit of both. 96.
He's not a 96 baby. He's not.
That's how. That's what I was in the community, and then that's how you can check someone's ID now. Oh, how much did you remember the fuel being the cheapest? And I'm like 79 cents. They're like, you must be quite young, Joe, because I remember it being 60 cents, and now with kids in 2000 or whatever it is, I remember it being $1.20. I remember it being $2, and that's how they now check. No, he's
funny.
not
Funny you mentioned that. I actually saw something on social media yesterday, and you were only mentioning it before, and someone saying that it was this younger girl posting, being like, I only ever put $30 in, so I've had no material difference to my life. It's $30 I was filling up last month, $30 I fill in this month, and I never put any more than that.
She's found the formula to beat inflation.
Yeah.
Just don't spend the money.
So spend it. $30 is $30.
Why have I been here 6 times? What's going on?
So to answer Jeff's question, is it doable? But I really like the second part of the comment that he made there, appreciating that it is a hard slog, because it's not easy, especially in the current environment where property purchase prices are where they are, where the holding costs are where they are, the interest rates are where they are, yields compressing nationally across the country, appreciating that this isn't an easy feat. So we actually will. I'll come in and I'll show you some of the. I'll come in and show you some of the numbers in behind an investor who has built a portfolio from scratch in the last kind of the post-COVID period. Our number 100K income portfolio. He bought his first acquisition some years ago. We'll have a look at it together. I'm pretty sure it was like 2013. So his secret was, well, I didn't do this overnight. I've been doing this for approaching his 14th or 15th year. So he's been a hard slog, chipping away at it every couple of years, going through and making another acquisition. Admittedly, for him as well, he's got into his first acquisition at a time where the lending environment was a little bit different. You could be a little bit more aggressive at even some of the major lenders as well. So we'll peek behind the curtains and have a look at a couple of those portfolios. But yeah, it's not an easy feat, but it's all about kind of getting into that first acquisition. And I'm sure most investors will appreciate if you can nail that location. That's usually the leg up that you need to help propel into that next acquisition. And it really comes down to the cash flow and actually being able to afford to hold these properties in the long run.
Have you seen any shift in, from all your times at Game Plans, in people's general strategy? Because obviously, like over time, it's gone from cash flow. Now it's more of a growth strategy because people aren't getting the cash flow. But have you seen any trends over the last 3-4 years?
Yeah, I suppose, and you hit the nail on the head where, I mean, if we kind of even come through that kind of post or during that COVID period there where money was cheap, everything was cash flow. So it didn't really matter. Everything was cash flow positive. And then there was obviously in the last few years where, and you're right, where the yields have compressed, the cost of borrowing has increased. People are putting more of an emphasis on growth and capital growth to afford them to get into the next acquisition, which I think has always been a way and part of property's strong point is the capital appreciation and using equity to help you get into that next acquisition, because for most people, the market will probably outpace your ability to save for that next deposit anyway. But I think that there has been over the last couple of years more of an emphasis on growth, less on cash flow. I've actually felt like a noticeable shift into 2026 where people are now starting to think a little bit more about cash flow, and obviously even more so in the last kind of few weeks since we had the war breakout and whatnot as well, and then a rate increase and all the talk around another rate increase as well. So now cash flow is starting to form part of these conversations as well. And the other thing that's really perking up is just affordability in general. Like, are there still markets where we can still get into these great fundamental assets that we think are going to perform in the long run, or are we getting priced out of certain locations?
One of the things that I've kind of seen over the years is people not thinking ahead on their portfolio, where they just buy whatever. They're like, hey, the broker says I can buy 900,000. Like, that's what I can borrow. Let's go buy it. How many properties should we be thinking ahead? Like, how do you think about it in terms of like, okay, great, because property 1, property 2, property 3, property 4, property 5, like it starts to become very, fugazi. Like, how far should, think in advance? Yeah. But how far?
I always like to just put the rough rule of like the next acquisition, because so much can change between that one and the one after that. We always just want to think, what is this property going to do is it going to improve my ability to get into the next acquisition? Is it going to hamper my ability to get into the next acquisition? And then by the time you're ready to go from 2 to 3, I'd almost put my mortgage on, or my house on the fact that your circumstances are going to change. Like, you could be talking 18 months to 3 years away, and you're going to have income increase, you're going to have income decrease, you're going to partner up, you're going to have marriage breakdown. So much is going to change between those kind of years. I love to do the modeling to kind of get me a bit of a feel for, I don't need to go and buy 14 properties overall, and maybe 3 to 5 good properties actually gets me to my end outcome. And that gives me comfort in knowing that whether I do one every second year, or whether I do one every 3 years, or one this year, one next year, and then I wait another 4 years, it's all about that fundamental comfort there, knowing that, okay, I don't need to go and buy 18 properties, but 4 could get me to my end outcome.
Yeah, it's crazy. It's crazy when you break down the numbers. And also, like, when you're factoring in growth, I was breaking down a unit that I was going to buy 7-8 years ago. And for whatever reason, I didn't buy it. We got outbid or whatever, because I didn't want to pay the extra $5,000 or $2,000 or whatever it was. I went back in time and was like, okay, great. How much could I have bought it for? It went for 185,000. And then now it's value. They just recently sold it for 600,000. So it's been growing at 28% capital growth compounded year on year.
And how much extra did you want to spend?
I made a mistake. Mistakes were made. Another asset was purchased, so that has done well. But I should have just bought the whole unit. Should have just bought the whole unit block. But my point in saying that is, like, the modeling that you do is at like 6.2% capital growth or 7% capital growth. The Australian average is at 6.9, 7.2%. So it's just that compounding year on year on year on year that people just, like, mentally, our brains are just not designed to think in these large numbers. And it's cool to be able to map it out and, like, okay, cool. Let's just say it doesn't crush it. Let's just say it doesn't do what it does every single year. Let's just say it doesn't do 7%. Instead, it does 6.2, and you still end up at a great outcome. I realize we're 18 minutes in. Let's jump into some of the cool stuff. I'm excited to see what a real person. Oh, I need to share my screen.
I think that's a good point, Joe, because I use game plans not for the general strategy, because I can do that pretty simply with some like Excel graphs, but I use it for the stress testing my portfolio. I go, what happens if interest rates go to 10%? What happens if, like, I only get 2% capital growth? So I get to see the worst circumstances, and that's how I build my buffers.
Yeah. You can factor in whatever you want, like 7% interest, 8% interest. Joey, can you just zoom in? This is me and Joey. This is what we do all day. It's like, oh, mate, just zoom in a little bit. Yep, just zoom in. So you've got, what do we got?
Yeah, I'll zoom in even further when I get into the individual. So we got a few people here. So pardon everything else. So this is obviously only available for our buyer's agent community. So this is our dummy partner here, Springfield Property Buyers, and these are some of Springfield Property Buyers' clients. So today we're going to have a look at some of these clients in through here. So we're going to come in and have a look at, I'm going to start with Bart Simpson. So Bart Simpson is our 100K income earner. I'm going to also look at Principal Skinner. He's our 250K income earner. And surprise, surprise, Mr. Burns is banking. He's our $500,000 income earner. And Curveball, just because his name was already in there and I couldn't be able to change his name. Ned Flanders is the dude who has been there, walked the walk. He is our Mr. Steve Polizzi. He's the dude who has sold down his resi portfolio to go and buy this commercial property. So we'll also have a look at Ned Flanders towards the back end as well. So what I'm going to do is I'm going to start by, I think, do we want to start at maybe the 100K income and then work our way up the ladder?
Yeah, definitely. So this is anonymized. Obviously, it says Bart Simpson, but
I haven't put in exact houses. I've just put in suburbs of where they're bought. but otherwise the numbers in behind.
Wait, so we've got the exact locations these people bought as well.
Suburbs, but not the property.
Oh, so good. Didn't know that. Okay, we'll
I'm going to be on
that.
a call with some client in the future, and he's going to be like, "Oh, I got an Oran Park, Bonnie Rig, Moreau." I'll be like, "I know who you are.
I know who you are. You're that dude. You're that dude." So yeah, obviously we've completely de-anonymized it. It's not Mr. Bart Simpson. It's someone else in our community. So the first property, let's jump in and have a look at it. So yeah, you can see there, the first property was bought in 2013. So this particular individual, he's built himself a pretty, I shouldn't say himself because it actually might be a female. They've built themselves a really impressive property portfolio, and actually quite heavily on the cash flow side. So this person has come in and done some value add. In fact, both of their Sydney properties actually have granny flats on the back of them. So the income is also quite high as well. But if we just come back and we look at the original first purchase, their purchase price of 590 grand in 2013, current value there is a 145, compounding growth rate there of around 7.2%. So close enough to the Australian average, like we were just talking about there, Joe. Their loan balance in this property is 410, which relative to the purchase price is obviously high enough, but relative to the current value is only a 28% LVR position, $990 per week in terms of income. This thing is producing some positive cash flow for this particular individual in the order of around $15,000 or $16,000. Again, this did not happen overnight. This property has been in their portfolio for 13 years now. That's property purchase number one. The other interesting thing to note is that this person does not have an owner-occupier. So obviously the owner-occupier would have consumed a fair amount of their borrowing capacity. And so this person is a rent investor as well. And so, yeah, there's no owner-occupier in their portfolio, only investment properties. Moving on to purchase number two, they were obviously still staying at their Sydney base, so still staying in their own backyard. It was a few years later, so obviously needing to take some time off to get the deposit ready for that next acquisition. So 2016, or potentially some equity increase over that period. 2016 was that second purchase. 745 was the purchase price, currently worth around 1.6. Similar growth, a little bit better growth in this one here, 7.9% compounding. Loan balance of 565K, which is a 35% LVR. And this one here, you can see the income is outrageous there with the dual occupancy. So, sorry, granny flat in the back. So dual income coming through from the property, $1,300 per week. Again, cash flow positive on that asset as well.
So 23,000.
Yeah, and this property here has also been owned for 10 years. So, and again, appreciate that the lending environment when they had made these acquisitions was very different to where we are today. We just pulled the highest portfolio value of our 100K income earners on the platform.
Which also a lot of money. 2016, $745,000 is a big purchase.
But this is that was going to be my takeaways. I think because they've committed to the leverage and getting a big one on the first one, they've won big to be able to multiply. Whereas if they started on a 300 grand one like I did, they could only buy another 300 grand one. So they've been able to step up much bigger because the first purchase was right.
Such a good point. Yeah, that's such a good little note there, because I see people like, oh, I've got borrowing capacity of I don't know, 800,000. I'm going to go buy two 400s, but they don't. They buy one 400 and then they wait 6 months, 9 months, 12 months before they get their next 400. So they've only compounded on their 400,000. Whereas if they just bought the not saying that, also not saying that 900,000 is the absolute best, but I see it where people are like, oh, cool. Well, mathematically speaking, it's better to break it down into 2, 3, whatever, but then they don't actually take the action on it. Whereas this person just bought, hey, I'm just going to go 745, which is probably, well, it's not, it's 1.6 million. We can see it now. Is like buying a $1.6 million property now, which is massive. And it's given them the return. That's for sure. But that still 7.9%.
That was the end of their big dollar value purchases. Then they've now gone, okay, I'm going to go outside of my backyard at this point in time. Then they moved into Queensland, gone into Brizzy next. And then the purchase price a lot lower here, 465 grand in South Brisbane in Maruka. And we can see here current value around the 1.2. This one, I mean, most of this growth, as we all know, would have happened in the post-COVID period, like all of Southeast Queensland has done. Would have been very flat for the first 3 or 4 years. And you can see the compound growth rate of 12.6%. Rental income there of $850 per week. loan balance relatively low against that asset because they only paid 465 for it. So they've obviously then gone, okay, well, let's buy the very best property that we can with our budget at that point in time. Because I imagine obviously things would have got quite tight for them. But again, I'm not sure when the granny flats came in, but the incomes against those two Sydney properties also are quite high because there are secondary dwellings in the backyards of both of those properties. So the incomes obviously help them hold the properties, potentially even help them from a servicing standpoint as well.
What's your general opinion of granny flats and when to do them in the strategy?
Look, overall, I usually would come in and say, let's acquire assets, and then come back and look at the properties and go, okay, now I'll come back and add value. The main reason why I'd say that, and obviously that's just a rough rule of thumb. We obviously stress test this on a case-by-case basis. Rough reason being is I would suggest, and most people probably suggest, it's going to be a lot easier for you to find 300 grand to do a granny flat than it would be for you to find $850,000 of servicing to buy another property. So if you had the servicing to buy an asset, I would rather buy an asset because, like I said, it's probably going to be easier for you to find the cash or the equity to then come back and do value add after you've accumulated the assets. Now, the caveat to that is you can, provided you can afford to hold these properties. Just this week, we actually had a session with someone where cash flow was critically important to them. They had some servicing, potentially not enough to get them into the next property. So they actually modeled in putting a granny flat on to increase the income. They didn't have the servicing to jump into another asset anyway. That actually allowed them some breathing space to hold their portfolio for a period. And then when serviceability increased, then they would explore another property purchase after that. So it's case by case, but usually rough rule of thumb, we'd say acquire and then value add after you've acquired the properties that you need to achieve.
I really like that. I haven't heard someone say that before. Like everyone always talks about, oh, it's good for cash flow, but I actually like, that's a good one. If you're worried about buffer and interest rates and you've got the cash flow granny flat, it's a very good way to mitigate some of the risk of like, cool, I can only handle $200 a week negative, build a granny flat, make that zero, happy days.
Yeah, and that's pretty much what we find for lots of investors. Obviously, depending on how much you're spending on the granny, you can go stupidly high spec and spend way too much money. But if you provide the right level of accommodation, provided the market actually has an uptake for it and there's an appetite for that particular dwelling, then actually can go very close to balancing out the negative cash flow for holding that property. But the obvious downfalls are there that you're contributing X amount of dollars of capital and borrowing towards that secondary dwelling, which could have knock-on effects. But for this individual, cash flow was so critically important for them actually going overseas. So their incomes are going to be reduced for an extended period. So it did make sense for them to do that. They weren't buying in the next couple of years anyway. Servicing didn't dictate that. Plus they're going to be overseas. So like, we just want to be able to hold this thing whilst we're gone. And then when we come back, incomes increase again, serviceability will increase. Then we'll come in and we'll continue building on top of the portfolio.
Okay.
Super interesting. So one of the things, just to kind of note on that, is one of the things that I see is people going into like this same conversation about what we just talked about with granny flats, but they think about it for development and they kind of hamstring themselves a little bit because what they do is they're like, hey, I can go out there and buy a 400, 500, 600 square meter block, but I want to have a development site. And then what they do is they go out there and buy an $800,000 block that costs an extra $200,000, but the rent, like tenants never pay the same proportion yield for a larger block. So what they do is they kind of screw themselves up for the serviceability because I've got 800 square meters. Instead, what we typically like where I see successful investors, and we can't really show this on, the platform, but where I see successful investors is they build their portfolio and they don't extend themselves too far where they can't afford it. And then they start doing the developments to pay down the debt. Because why hold this asset for the next 10 years to eventually develop it, paying all of this negative cash flow when you could just, well, how about you buy something that's growing, keeps your cash flow okay, and then in 10 years' time, buy an asset that you can develop and then flip that and flip that and flip
Straight
that
away when you're ready to,
as you need. And then just save all the holding costs, because those holding costs, those additional holding costs need to be factored into the total development costs, and it just won't make sense as a development. Just a bit of a...
Do you find as well, Joe, I would say 90% of the clients that tell me they want to do those developments on a property are never going to do it, and are also not the personalities to do a development. They just like saying, I want to do a development. Like it's a different game completely.
Yes. The answer, yes. Property development there's a lot that, like, if you just like the idea of property development, no, you need to do courses. You need to spend the time understanding it. You need to understand council. You need to understand the process before you start getting into it, because otherwise you go in like you can get screwed over. You know, we're doing a development right now in the Oz property portfolio. And there are points where I'm like, oh, we could easily just let this slip and let this slide and lose tens of thousands of dollars, but we have to stay on top of it. And people that get excited about property development, just not all, everyone, obviously, people that do developments is good, but yeah, just don't go into developments eyes closed. Is kind of what
go watch the one we did. What was it, 7 weeks ago or so with Joe Natoli? That was a really good one where she went through. She was a really successful developer, did one bigger one, and the whole house of cards fell down.
Oh wow. Yeah, no, I wasn't on that one. I will go back and watch. Everyone else should go back and watch as well. Okay, hang on. Where are we, Joey? So this person has purchased 3 properties so far. Can you zoom in a little bit? So far the value is 1.6, 1.2, and what was the value of the last one?
1.6, 1.2, and the first one was 1.45.
Okay.
1.4.
So we'll show it cumulatively in a second. So 1.45 plus 1.6. So we're basically at $3 million there alone, plus 1.2.
4.2.
So there we are, a tick over 4 mil. And then the last asset that they've added into the portfolio was one in Toowoomba. Again, purchase price not as high as the other one. So 510 purchased a couple of years ago. 4 years ago now, 2022. 840K is the value. Compounding growth again has been quite strong in the area. Loan balance there of 405, $650 per week in terms of rental income. This one basically looking after itself from a cash flow perspective, not as cash flow heavy like the other ones are, because they've only recently just bought this asset. And when I say recently, they've owned this for 4 years. When they would have bought this, probably would have been negatively geared from a cash flow perspective, and then they would have had rental income increases. The rates would have upped and down and fluctuated from 2022 to date. Now with the rental income increases where they got to their $650 per week in rent, now they're about cash flow neutral. So this is something that we see all the time, Joe, where people come in and see the negative cash flow carry in year one and go, damn it, my life is finished. But over time, that story starts to
by 10. They're like, the next 10 years, I'm going to be losing 15 grand, 20 grand, 25 grand. Not necessarily. Rents are going to rise, but interest rates may change as well. So you have to factor in your buffers.
We might be getting to this, Joey, but I imagine they've gone to these smaller purchases because as times went on back in like the early 2012s and that, servicing wasn't really an issue. But now, as it gets closer to now, that servicing is forced to not the actual equity position.
Exactly right. And now it's critical for them. So now obviously they're working with the limited budgets that they've got. And in fact, they haven't purchased in 4 years. Because they're at their serviceability peak. This is just a rough guide here, using 6 times income.
It's pretty much spot on.
Now they're at the top of their peak where they did buy those first 2 Sydney properties. Lending was a little bit easier, and so they were able to go a little bit more aggressive. Now they're buying within their means, and in fact they haven't bought in 4 years.
But just to recap where we are, this person has a $5.4 million property portfolio that they started 13 years ago. They bought 4 assets. And it's worth $5 million. They now can't buy any more properties. They're kind of stuck because of their income. But right now they have a $5.4 million property portfolio with $100,000 income.
3.6 in equity as well. So if they would liquidate that thing down, really strong equity position.
I think the impressive part, Joe and Joey, is like 100K. Most people can only borrow 5 to 10 times their income. So that's like 100 grand to 500 grand. They're at 5 mil. So they're 50 times their income, which they've done. Again, not quick, but over time, this is obviously why it's one of the top performing portfolios.
This is the top performing $100,000 income. And I did have to stress test out because I'm sure there's plenty of business owners that put themselves at a $100,000 salary. So I was able to quickly identify those ones and weed those ones out because some people come in and they'll put in occupations and employees and things like that. So this is what we believe to be our number one $100,000 user. And you hit the nail on the head there. This wasn't in the last 2 years. This was over the last 13 or 14 years worth of property investing. And they have gone quite active with their approach, right? It's not a passive thing. They've come in, they've added value to 2 properties. When I say added value, they've added income to 2 properties to boost the serviceability, to boost the amount of cash flow that's come through, to potentially help them to get into that next acquisition as well. So they haven't just sat back on these ones.
But also 13 years is a long time. Don't get me wrong, but it's not that long. Like to be able to create $3.6 million. If you told my 13-year ago self person, you can just buy 4 properties and you'll have to $3.6 million worth of equity is absurd. And it's the same as right now. Like the compound that we're talking about is 7. Well, what was the average compound for that? Probably 10%. Actually, they did
probably, yeah, because there was 2 7s and 1 12 and 1 13, so it would have been close enough to 10%.
Absurd. Nice.
Which is,
okay.
obviously it's a really, really, really solid portfolio. But should we now jump up the rung in terms of the income?
Yeah, let's go.
Yeah.
So let's go
just
from
the takeaway from that portfolio is, I think what we kind of alluded to. Yeah, we kind of alluded to it before, was they've just gone in with a big property at the start, and that's performed well, and it's all leveraged from there. So I imagine that's a takeaway. Use your servicing as early as you can to get into good assets.
Okay, so can we just hit? So there's 3 things that you need to purchase your next property. It's cash and equity, borrowing ability and serviceability, and cash flow. I probably say this every week now. Can we go back and see what his income is now? Because he's built, like, he's 13 years in, and he's made a conscious decision to take his portfolio and continue down the growth path and add granny flats to help with his income
from the property portfolio.
Yeah, how much is he making money, or is he negatively geared? Like, where is he at?
He's making money. He's making money now. Not heaps, 37 grand.
Wow.
Across the portfolio.
In this interest rate environment, awesome.
Yeah, so exactly. So his cash flow is being looked after by the overall portfolio. So if you come through here,
after all of them,
there's the income, there are the expenses, and that's his. I mean, that's not taking into account the full picture. It's 37 grand. Is what the actual cash flow position looks like right now for that particular individual. So he's not retiring just yet, but he's well on his way to hit his income goals.
He can 100% sell up and buy some high yielding assets and have a really good passive income. Like put that 3 mil into, I don't know, 6 mil commercial, for instance. He'll be 200 grand a year positive.
Yep. And that's basically what, I mean, Ned Flanders has gone to the nth degree with his portfolio, but we'll come through and we'll show you his, but that's exactly what he's done. But yeah, you are right. Bart Simpson could potentially do that.
So Bart Simpson's the student. We now have the principal Skinner. This is the guy that's done things a little bit differently. He's got a little bit more of an income. And by the way, when we're talking about income, this is household income. So I imagine that Bart Simpson guy, which is 100K, is someone that is single, right? Like he's single. He doesn't have he doesn't have any dependents. He doesn't have another income coming in to make it. So what is the household income for this person? Or is this another 100K guy?
250. Oh, this is 250 income. So Principal Skinner's, we're jumping up the.
So this is mum and dad. Well, maybe not mum and dad, husband and wife or whatever.
Principal Skinner lives with his mum, Joe. So it's his mum and his income.
What was that? What's the other teacher's name?
Mrs. Krabappel. He also made up with her on the call.
She's a liability, is
So interesting thing to note here is just even at like high level, just as I'm scrolling down here, you can see a lot more images, which means a lot more properties. In fact, you can see here there's 9 properties in this portfolio. So I've taken a big jump up in terms of the number of assets in this portfolio. And it starts out pretty similar in terms of the geographical spread, buying close enough to home. So this investor here is also Sydney based. And you can see this is based on date of purchase. So buying in New South Wales first, now we're venturing out interstate, and then we're staying interstate.
What time did he buy Warnbro? Like that?
We'll come in and we'll look at each of these properties. So the first one here was bought in, and again, this was not done overnight. Look at this first year of purchase, 2003. Purchase price of 180 grand, current valuation of 700. The loan balance is $125,500 a week of income. Again, this is not getting rich overnight. This is getting rich quite slow. So this is a 23.
They've still bought a beach property for 183 grand.
Yeah, 700. Does that sound about like maybe it's not? Maybe it's even more.
I'd probably suggest that it'd be a little bit higher than that.
It might be about. Is it like a fibro shack kind of thing?
Yeah, it's like a little beach shack. It's a little beach shack. So, but I'd still suggest that in Gerringong probably worth a little bit more than that. But anyway, let's take the 700K valuation.
Go the low one.
Property number 1, and then we move to Kiama, and some years later, so it's about 9 or so years later, we've taken the leap into another acquisition, 154,900, so 155 grand, now worth a tick under $1 million, which is probably close to where I'd see Gerringong sit as well. Loan balance of 208,000. So obviously you've done a refinance against this one at some point in time, considering the purchase price is less than the current loan amount. And these things here, again, this is a 14-year hold from 2012 to date. And they've had some really strong growth against that asset as well. But still quite similar. So a couple of properties, coastal, New South Wales, South Coast, and even this one here in and around a similar area, right? So Nowra, I mean, not as coastal, but South Coast enough. 2013 purchase, 220 grand. Current valuation sits around the 660. Current loan balance of 155,000, and so $500 a week coming in for that asset. So there's a couple of acquisitions in relatively quick succession. So we've gone from 2003, we've taken 9 years off. So who knows what happened then, kids and whatnot. And then a 2012 and then a 2013 purchase relatively in relatively quick succession. Purchase prices weren't outrageous. This is the biggest purchase price that we've seen so far with 220 grand. Then we now move Interstate, and we've gone Warnbro next. Purchase here of 2014, which I'm not sure if that's accurate of a 320 purchase. Maybe not. I'd suggest that purchase price there of 320 would probably be more.
Well, no, to be honest, like that.
Or is that about what you'd expect, Joe?
That's about shit buying. Like he bought,
yeah, right.
Like that's like Warnbro in WA stuck from 2014 to about 2021.
Gotcha. So did nothing. All of that growth has come now.
Yeah. So if you did if you actually looked at the chart, it would literally just be stagnant, and then in the 20s start to jump up. But that's the interesting thing is like these things go in cycles at 7.4% annualized capital growth. So the longer you hold a portfolio, you'll start to see, great, oh my gosh, I've got 33% on this portfolio. Yeah, it will. It's not going to be rocket ship the entire time, but the rocket ship definitely helps you get there, and also different locations. So what can we take away from these acquisitions? Like what are you taking away from the way that this person has gone out about and invested? Because I mean, I'm looking at these time frames and I'm like, I don't necessarily think this is the best time to buy, but time has healed a lot of wounds here for it. And that's kind of my takeaway.
Yeah, it just would have been what made sense for the individual at the time. And who knows where the data came from for them to make that purchase there in Warnbro in 2014. But you hit the nail on the head. If they had a season of or 6-7 years of absolutely no growth, this person would have gone, I'm just going to sell the thing. I should just sell the thing. And then all of a sudden, boom, they've had all of this capital growth in the last couple of years. But for me, it looks like buying where they could afford close enough to home. I'm assuming with the Gerringong, Kiama, Nowra purchase. And then they've gone, all right, now I'm going to spread my wings. Probably didn't nail the acquisition. I dare say they wouldn't have seen much growth in this asset for that period, like you mentioned. And I'll be interested to see where they went to or how quickly they went into the next acquisition post 2014.
I think you'll find, guys, prior to like 2014, there wasn't really data to make decisions from. You looked at generic thing, but it was all back then yields and cash flow. Like
it was literally, it was literally yield. It was a magazine that said, oh, this market last month went to 6% yield. Now it's 6.2. Is that good or is that bad?
Yeah. It's medium house price and value and what yield and cash flow you're getting from the property.
So now we've gone, I like the interstate thing. I'm now going to go to Queensland. I've bought in 2018. So 4 years off. So 2014, now it's 4 years off to 2018. And we've made a 540 purchase. Current valuation, 1.25. Again, lots of that growth probably would have happened post-COVID as well. 11.1%. And then you can see the 780 per week in terms of the rental income coming through from that asset. So
guys, in the comments, you guys are following along just as much as we are. What are you taking away from this portfolio? Like what lessons are you taking away, or nuggets, golden nuggets that you're kind of picking up from this? Because I'm keen to hear what you guys are thinking as well. Watching these numbers, 131% growth. Sorry, Joey, carry on, mate.
No, I love it. So 131% growth for this asset. 4 years off between drinks, between Warnbro and Morningside. And then we've stayed in Queensland with another acquisition in the same year. So maybe there was growth in their New South Wales portfolio that allowed them to get into a couple of acquisitions in the same year. 411 is the purchase. Again, growth here north of 100% over less than a 10-year period. So that property's doubled in value in much quicker than 10 years time. 10.6% compounding growth. Loan balance of 450 grand, 750 per week in terms of income. So a couple of Queensland acquisitions back to back, bang, bang in the same year after a 4-year hiatus from property investing for Principal Skinner.
Incredible.
Then we go there. We're 6 properties deep at this point in time. We're really enjoying Queensland because I can now see the next 2 purchases are also in Queensland as well. So then we move. We've had some years off, so obviously that little maybe COVID-ish hit as well. So it's now not until 2021 when we make
Still
that next
brave.
acquisition.
Investing in 2021 is still very, very brave. We were all getting out of the office. We're all working from home. Like it was still pretty bad in 2021 for COVID, and property was not the hot ticket.
The one thing that stands out to me instantly with this property is the rental income. So I'm looking at this going, okay, well, there's a granny flat, there's dual income, there's something about this property that is now, we're now talking some serious income in behind it. I might actually come in and have a quick look behind it. Let me go back. Actually, there you go, commercial property. So they've now come in and they've bought a commercial acquisition. I was just looking at that rental income there going, that's quite high for a resi asset. And Steve, there you go. You'd be happy to see who says commercial property.
I was going to say,
who says commercial property doesn't grow?
There you go. I have a feeling the Morningside might be a commercial as well, because that's an industrial precinct.
Yeah, interesting. Yeah, I'd be interested. I don't think the rental yield was probably high enough for it to be there, but I'm looking at this going, that's a high yield. Yeah. And there you go there, 9.8% compounding for this commercial acquisition. So I dare say that they would have run some very conservative growth numbers against this property and would have been pleasantly surprised with the capital appreciation that they've had over the last 5 or so years with this property. So now towards the back end of their accumulation phase, now they're starting to chase a little bit more yield here. They've added the commercial property into the portfolio, and then we've stayed in Queensland. We can come through and see here, what's this property? This would be a resi asset, I'd say, given the purchase price and the rental income. A 2022 purchase, 510, 850K valuation. Again, really strong growth, 13.5% compounding year on year over the last kind of. So
that's a Townsville purchase.
There you go. Yeah, Townsville purchase there.
Yeah.
So this person is maybe they've caught on to the data at this point in time. So maybe no real strategy early, and then they've kind of gone, actually, there could be something in this data thing and this property investing game, and now they're getting really sharp and they're kind of nailing the right types of properties and strategically putting them into their portfolio at the right point in time. And this one here I found quite interesting because I'm fairly sure that the last acquisition in their portfolio was an owner occupier. And so then they've now added an owner occ in late in the portfolio. And I actually do know who this person is. And I know that they had a sell down so there were more acquisitions in the portfolio and actually sold a couple of them down to help them finance this owner occupied purchase. But it's interesting to see that they ended up buying that dream home at the end of the portfolio. So they did all of their investing first. This is a really key takeaway for me. They did all their investing first and then actually got into that dream home. So there was another investment and there was a smaller owner occupier or and not as high valued one as what they have today in their portfolio. They sold an investment. They sold down their old PPOR CGT exempt gain, and then they've now jumped into their forever home as their last and most recent purchase in the portfolio. And you can see they're geographically a pretty nice spread across the country. So you've got a fair concentration in the south coast of Sydney. Their Sydney purchase is their owner occupier. And then they've got a couple there in Brizzy, one on the sunny coast, one up in Townsville, and then the WA purchase as well. But yeah, really interesting for me is go and let's get our investment portfolio sorted first, and then we'll worry about our dream home, which I loved as a key takeaway. Because obviously people get really gung-ho about wanting to buy that dream owner occupier as early as possible. And gents, I'm sure you guys have seen this 1,000 times over. That fundamentally can impact your property portfolio. It'll consume probably most of, if not all of your borrowing capacity. It'll probably chew up most of your capital because you're going to be sinking in a big deposit. If the broker tells you can borrow 1.2, you're probably going to go and try buy a property for 1.6 and sink in as big, if you know what I mean. There, like you just try and leverage yourself to the hills to try and buy that dream home. But this person is actually going, no, I'm going to put my investment property first, my investment portfolio first, and then at the end of the day, once everything's looking after itself quite nicely, that's when I'll go in and and he has a really low. He had a $378,000 loan against a $2.8 million portfolio of property in Sydney.
Wow. I guess
sorry, Joe. I was going to say, similar to Bart Simpson, they've both injected cash flow properties, not early on, but midway through their portfolio to help with obviously interest rate stresses. So they've done it with a commercial but did it with the granny flat strategy. So they both still needed the cash flow. And I suppose that's a good argument between cash flow versus capital growth is you need to put the cash flow in somewhere.
Yeah, I was thinking about this actually just a couple of days ago, where there's kind of three pillars, isn't there? There's the acquisition phase where we go hunting and going out that. Then there's a consolidation where we start to sell, like value add and do granny flats and subdivisions and developments. And then there's the cash flow. But those are three strong pillars, but they're not individually broken up like that. They overlap. There's a phase at which the consolidation, where you're consolidating and then also going for a cash flow play at the same time. Like it does, so I think breaking it down into three strong pillars doesn't really paint the picture of what is actually reality. It is more of there is times where you will be consolidating the portfolio and then getting a cash flow straight away, and then going back to the consolidation to pay down the debt of that cash flow. So I guess, I mean, that's just a little thing that I think is important to know is just don't think if this, then that. It's like there's so much nuance in between this, and it's cool to see these guys doing it.
So this person's got themselves a 10.7 mil portfolio, of which we saw about 2.8 was consumed with the owner occ, so about $8 million in investment portfolio value, and about 2 point and the balance 2.8-ish in their owner occupier, 7.7 mil of equity. Again, lots of that sitting against the owner occupier. So if you strip that out, it's about $5 million.
Can you zoom in, Joey? I can't see any of that. I can't see.
Can you see this little pop-up box?
No. Well, I can, but it doesn't grow with the.
Yeah, it doesn't grow when I zoom in. It just zooms into the year.
Right. Okay. So it says market value 10.7, total debt 3 million, total equity $7.7 million, and then he's got $5 million borrowing ability. So 5 million. Sorry.
No, that's borrowable equity.
Borrowable
He doesn't have
equity.
that in serviceability. No way.
No.
So yeah, he's got about $5 million worth of investment equity. If we say that about 2.7 is tied up in the owner occupier, but again, overall, a $7.7 million equity position is absolutely incredible.
So, what are you taking away from this portfolio, gents?
I'm taking away. So generally, every 100 to 125 grand, if you do really, really well over 10 to 15 years, you can do basically a 5 mil portfolio for every 100 to 150 grand. So if you earn 400, 500 grand, you can get close to a 10 mil portfolio. If you earn 100 grand, you can get a 5 mil portfolio. So like they're the real numbers, not the wanky buyers agents news.com. I've got a 20 mil portfolio on 150 grand. Like that's the best. And that is amazing. Like for someone to earn 100 or 200 or 300 grand, having 7 mil worth of equity is just ridiculous.
Yeah, but again, you could just sell that all down. I mean, what was it? 7.7 or something like that?
7.7.
That'll pay for all the costs. Then he's got 7 mil. You could literally just put that into a savings account and make 4 or 5% and make millions.
But they also did what I love and bought the dream house. They've literally.
What's his gross rental income?
No debt. They got their Roseville, like unreal, like happy days.
Yeah. What's his gross income? What's how much income has he got? Great question.
All these little zooms you're making me do, Joe. It's now just spinning my spinning my browser out.
His gross rental income is going to be careful because obviously the last one was PPOR, so was that hopefully put zero in that.
There was really low debt against the PPOR as well, so that's something else that we need to come in and remember. And now once my computer sorts itself out, I will tell you what their gross rental income from that portfolio is.
Yeah, or just if you can do it on the graph before they bought the PPOR, just so you get an idea.
Yeah, just refresh that. We got to run to our first sponsored ad. What I want to go cover off next is run through what the answer is to that question. And by that time you would have fixed it, and then go deep into what have we got? Another person that earns 500,000.
We've got 500,000, and then we've got someone that's sold down the portfolio and done what we're mentioning now and reinvested into that high yielding property.
Let's do it.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
Good stuff.
You're back.
Check it out. He wants to give away a few more books.
I've given away 50,000 plus now, Joe. 50,000.
That's
So a lot of firewood.
That's a lot of paper. It's a lot of trees.
A lot of COVID toilet paper, Steve.
That's right.
So,
Had the COVID. Yeah. What's his income?
if I can reveal the gross income there is 96 grand coming through after so that'll be net income, net of the expenses there, $96,000 worth of income.
Wow.
The overall portfolio is producing in terms of income. It's going to be a lot higher than that because that's the 96 grand is the number after we've factored in the outgoings. $293,000 worth of portfolio income. So a really strong income position for the portfolio after the expenses. We're still close enough to $100,000 worth of passive income for Principal Skinner. 250 grand, 9 properties, 8 investments, juicy owner occupier, really low debt position against that owner rock as well, which I love.
Couple of great comments
gives
here.
them options as well. They can go do 100 grand a year jobs. They can do contract work and have 6 months on, 6 months off. Like they're done.
100%. So much choice and opportunity. And I mean, their portfolio has the compound is like 7 to 10%. That's kind of what I'm seeing here. And it's being able to create so much life for people. That's kind of my takeaway on this is, one, you don't need to be the best investor. You don't need to time the market. You don't need to do all of these things. All of these things that we talk about bloody help the situation. If he bought Warnbro in 2018 instead of holding it, 2020 rather than holding it from 2014, he would have absolutely killed it and blah, blah, blah. But he didn't need to do that. He could mess up and buy at the top of the market, hold it for an entire cycle, get zero growth, pay the annoying stuff. But over 10 years, it paid off. It paid it off for him.
Averaging over 7%, right? Yeah. And that's really interesting as well. Like the average that we've seen is somewhere between 7 and 10% of growth across these couple of portfolios, which is really, really interesting to note.
There's a great question that asks this. Any house and lands in any of these portfolios? Have you seen house and land packages? Not have you seen, but did we see any? I didn't see.
None of the, all of these were established properties. Obviously, there are plenty of clients on the platform that do have house and land packages. Some of them have done okay. The ones that I have pretty much always seen not do okay are off the plan apartments in over concentrated areas. In fact, I just saw one today, 10-year hold, negative 1.2% capital growth over 10 years. Obviously, that is a huge opportunity cost for that particular investor. And that they're the numbers that we don't love to see. And that was an off the plan apartment, house and land. Yeah, we do see some of them, but none of these clients here in these portfolios were house and land packages.
I also think it's good to just discern the house and land package of like, if you built the property yourself, got your own builder and organize it, you can actually make some money on these house and land packages. But if you're going direct to the spruiker, it's not going to do as well. So I do see people like, I'm so sorry, but I feel so bad for myself. I bought a house and land package. I'm like, dude, you made 200 grand. Like you made 200 grand because you did it, you built it, that's now like, yes, that was over 10 years. And yes, you could have done way better if you optimize it, but you now have what thousands of people are after a deposit for your next property. Sorry, go on, Steve.
I was going to say similar to that. They theoretically, the Principal Skinner could have bought a house and land package because he didn't time the market that well. So like if he bought one back then, instead of, I can't remember what the first property price was. It was like 215 grand or something.
Less than that, it was 180 grand or something.
He could have probably bought one for 280 grand or whatever, but on 500K, that would have dissolved it. And he still would have a 10 mil portfolio now. But my biggest takeaway from that was he's timed the market terribly and still been the top game plans performer. So my takeaway is he didn't stop. So even though he had properties
he
that
kept
probably
going.
weren't growing, with his income, he's like, well, I'm just going to keep chipping away at here. And then obviously had the 5 or 6 properties and then got through the COVID boom and happy days.
I saw a house and land yesterday, and the guy had done fabulously well out of it. It was his owner occupier, and he bought the land and he built the property, and he's had like 350 grand of uplift in not a long amount, like in a really short amount of time. It was his owner occupier, and he thought, well, if I'm happy enough to live here, I think there's going to be demand from others in the area, and he did well out of it. But none of these guys here had.
When I bought my first property in 2012, I bought in Blacktown, house and land. I bought a little unit thing for like 230 grand. House and land packages in Kellyville were going for around 450.
Yeah,
and they're now around 2 mil. So like you can still do okay long term, but if you're trying to accumulate fast, you obviously don't want to have those losses early on.
Yeah, it's because the supply has to catch up. Like like Castle Hill and those type of places as well. So okay, that was good. That was really good. So the other thing, actually, my other little micro takeaway is there's a bit of a disparity because some of the areas that he's bought in New South Wales did like 6-7%, and then the other ones in Queensland, WA, were doing like 13%. The point that I get from that is, if you are moving quickly in a market, do not be afraid to buy multiple properties in the same location. So Jeff and I bought the Oz property portfolio. We bought 5 properties within, 9-month period or whatever it was. Someone will correct me. And 3 of those are in the exact same suburb because, let's have a look at the data. Is everything stacking up? Yep, here it works out well. Is the everything? Oh, we're going to have to buy here again. Oh, the great deal came up. Great, let's buy that. And if he did that, if he bought all of his portfolio in that Queensland area, he would be up 13% versus 7%. So if you've got the confidence, if it all stacks up for you, don't feel afraid to push hard and go in that area, because it's not going to be overcapitalizing. If you buy 10 there, maybe, but if you buy 2 or 3, it's not going to be overcapitalizing for your portfolio for sure.
I think that was an easy decision 10 years ago, Joe, when people weren't using data as much. Where like, yeah, I know this area, it's good, I'm going to kind of double down. Now, I think there's probably more of an argument to not go buy 3 in one area. Like, you'd have to see some very attractive numbers on some of the data platforms to be like, this is the golden goose. But again, we're talking like, if you want to buy Brisbane, you don't have to go buy 4 in Logan. Like, there probably are different segments of Brisbane you can move to as well.
Yeah.
Should we have a look at that greedy Mr. Burns?
Okay, let's see what Burns has got for it.
Excellent.
I was waiting for that. I knew that was going to come from one of you two.
Not from me.
I've even got a Simpson tattoo.
Investor. He needs to. You have what?
I've got a Simpson tattoo. It's
Where?
it's dignity.
You showed us a potato.
When what do you call him? Millhouse's dad's trying to draw dignity when they're doing Pictionary. Random one. Don't worry about it.
I do remember that though. I do remember that. It's in Homer and Marge's house in the living room, right?
Yeah, that's right. It's when the parents split up and he's like, "It's dignity, damn it."
Anyway, let's jump in and let's have a look here. So, interesting thing to note. I'm just going to scroll down quickly first. Not a drastic increase in the number of properties. So we've got
so what are we talking? Who is this guy? Who's Mr. Burns?
This is Burns. Burns is on. He's not quite on 500. He's on 460,000. Doesn't own his own. It's not a business owner. I know the company that this person works for. I actually have met this person before. Sophisticated investor, not as old as Mr. Burns, so it's actually quite a younger investor, but on obviously really, really high income, 460 grand, and has built a 10 property portfolio, which we can come in and have a look at. So we've got the first property in Bondi Beach, which is a unit. Year of purchase was 2016. And we can see there 850K purchase, 1.5 mil valuation, sub 6% growth rate, so 5.8% growth. Rental income solid, $1,100 per week. I actually know where the property is. It's very close to the beach, so obviously good area there from a rental perspective. Capital growth's been there and thereabouts. Obviously not the 13% that we've seen on other properties, but 5.8% compounding over the last 10 years. hasn't quite doubled in value, but obviously he's done fairly well from a capital appreciation standpoint.
So the yield is 3.8%, like on current valuation,
$1,100. Yep.
$1,100 a week rent is on a 1.5 mil is 3.8. That's ridiculous. Well, not ridiculous, but it's interesting.
Relative to what he paid for it, though, he'd be he's in a strong enough cash flow position. He's got a loan balance of 800K, so the property's self-sufficient from a cash flow perspective with his loan sitting there at 800K. That's property.
Are you telling me Jack Henderson's wrong and these blue chip apartments on beach suburbs, on the eastern suburbs, aren't the best performers in Australia?
I'm not saying that. I'd be happy enough if my property went from 850 to 1.5.
I think the key takeaway for all these portfolios is just you got to have a go and let time do its thing.
Exactly right. Exactly right. And there would have been some ebbs and flows during that period, no doubt. And then they've gone and they've doubled down in Sydney eastern suburbs, beachside location. I'm fairly sure this is the owner occupier there. This is the principal place of residence here, worth around $4 million in neighbouring suburb of Maroubra. So purchase of 2.8, now worth $4 million, 7.5% compounding growth. This one's done better from a growth perspective. Maybe goes to speak to the house versus apartment conversation, perhaps. So there's that acquisition there, and you can see these acquisitions have been fairly recent because, like I said, not an older, not an old dude, fairly young. Did have an owner occupier before. Again, sold that down to then pivot into this property. Another really common thing that is, I think, doesn't go spoken about much at all. It's actually the CGT exempt gain you can make from selling your owner occupier after a renovation or after X amount of period of a hold. And that's what this particular individual did. They actually owned in the area. They had a semi, renovated it beautifully, sold it at the top of the market, and then reinvested into their new owner occupied purchase.
I was going to say I would have envisaged that the Bondi apartment they would have moved into, then moved out. And then bought the next one, changed to an investment property.
That's exactly what this person did. They lived in the Bondi unit, then bought a semi in Maroubra, renovated it, sold it for a really nice gain, and then bought something like an unpolished gem in Maroubra, a bigger property that they've since renovated as well. So again, taking CG, they used equity in property one to help them buy the owner occupier, then a nice CGT exempt gain to help them get into that kind of dream home, if you like, in Maroubra.
But that's the sacrifice, right? Like that's the sacrifice people don't talk about is you have to live in an ugly, you have to have a pink bathroom, those pink tiles and pink everything, like pink bath, but being able to renovate it and then flip it eventually and sell it and have that gain tax free is absolutely absurd. So if you're in an area where there are affordable properties and you can actually do something like that, that is such a good strategy that will beat a lot of the other top markets. Like if you can buy a $600,000-$700,000 property where you live and live in it, then renovate it, then add some value, you don't have to pay tax. I mean, also if you hold your portfolio, you can just extract the equity. Don't get me wrong. You can still do that with the PPOR, but just have that in the back of your mind that is a strategy that has been very successful for this guy because he's got 450K. That's a lot of money. It's a lot of cashola.
So we're two properties deep at this point in time. Then he's gone and spread wings from an investment standpoint. And we've gone over to WA for a purchase of 385. Again, there's your 13% growth again. So there's like a common thread that keeps coming back here. Obviously, this one timing was a lot better. So he didn't have to do the whole buy it in 2014 and wait for capital appreciation, bought it at the right time. 385 uplift to 710, 650 per week in terms
Why is
of
he doing income. This?
Sorry?
Like, why is he doing this? Why is he buying? Okay, so he just bought a $2.8 million property portfolio. He earns $450,000. He's buying was 325. That is 8 property. He would have to buy 8 of these to reach the same $2.8 million. Like, it's interesting that he would only go out there and purchase 385,000. Like,
well, maybe the future purchases. You'll see there's a few purchases in relatively quick succession. So it might have just been spreading kind of cash across into different markets. But you are right, and obviously he's done pretty well from a capital appreciation standpoint, nonetheless.
Killed it, yeah.
But yeah, he's gone pretty aggressive in terms of
pretty hard, pretty fast.
Yeah, the frequency of purchasing. You can see he's actually bought another acquisition in the same year, 2021 as well. So he's kind of thrown 300 and something grand over into WA, parked 570 into Queensland, and there's your north of 10% growth again, 11.1% growth on that asset, 575 to a 975 current valuation in Eagleby. And that was in the exact same year. So both of these in 2021. And I think the next one was pretty soon after. Yeah, there it is there again. So he's gone back to WA, south of Perth into Bunbury. 2022 is the year of purchase, and he's bought a property for 380 that's now currently sitting close enough to $700,000. And obviously he's had a fair chunk of capital appreciation over that period as well. So he's gone pretty aggressive, and I suppose that was his rationale. If I've got X amount of dollars to spend, am I going to go and park that in on one big asset, or am I going to go and buy multiple small, not cheaper properties, but yes, relative to going and buying another $1.5 million property in Sydney, for example, he's gone and bought multiple investments in different parts of the country.
Such a shift in his mindset. And the fact that he actually that's the difference. He's actually gone and executed the more affordable properties. Yeah. But look at the compounding growth. Yes, he could have bought one extra property in Bondi and paid $2.8 million and done the Jack Henderson 5.6%. But he's decided, you know what, I'm going to break it up. Instead of breaking up into 8, like I was saying, he's broken up into 5. And then that is now grown, what's this one? 16.5%. So averaging 14%. So you don't need to go out there and have a 2% yield on these Sydney properties or these high density rubbish. What matters the most is the compounding growth on the total invested. So it's not
you mentioned, Joe, why he's gone the cheap ones. I envisaged that potentially because he's had the big one and now he's focusing more on cash flow and he's buying the cheaper ones with a good yield.
Yeah.
So he probably saw the holding costs of the big Maroubra one and was like, okay, let's get some cash flow.
Well, interesting that we're patting him on the back, because look where he goes next. He goes back to Sydney.
Yeah.
He goes back into Sydney, and he's obviously bought himself a unit here, maybe playing into Steve's camp there.
Got a mistress. Mr. Burns has a mistress.
No, I think maybe he's doing what Steve said there, where he's now starting to think a little bit more about cash flow. And he's gone and bought a 670 odd purchase. That's
5.2% yield.
Quite high, yeah, right. And so he's gone for a little bit of yield here. Interesting to note the compounding growth is the exact same as the Bondi apartment. So 5.8% growth for the apartments. Obviously, the houses were trending a little bit higher than that, but a yield play, it seems, at this point in time. So very interesting that he's gone quite strategic.
That growth, that compound growth one is like he's only had it for 3 years. So
correct.
That's going to be, it could be 12%. You can pat yourself on the back, but it might not do anything for 5 years.
Yes. Yeah, exactly right. Whereas Bondi has been proven it's 10 years and it's done 6%, whereas Rockdale might have had a peak in the last 6 months or one year run, and then the rest it's done absolutely nothing. But I just think really, really interesting to go backyard, strategic interstate investments. Couldn't get further away from Sydney if he tried. Then let's come back home. Maybe opportunistic. Could have been other reasons why, because then he's actually gone back interstate again. So then he's bought back in WA after the Rockdale purchase. And we can come in and we can see here, again, the compounding growth rate is what I'm looking at instantly. 640 purchase. I'm going to jump in and have a look to see what this property here is.
That's a commercial
property. Again, I just saw the yield.
As a commercial precinct we buying. So as soon as I saw the yield, I was like, that's a commercial.
How do you like the compounding growth rate, Steve?
This one, Steve. This one is an average, Joe. Don't worry about that. It's like the last 3 years. This is what we always get in commercial.
14.1%.
2023, we've averaged it out nicely, have we?
You heard it here first. So then I think we hit the nail on the head there, where he's now gone, okay, I've got some cash parked here in Sydney. I'm now going to look for yield, because he's really gone, especially with, the Bunbury purchase was yielding quite nicely. The Rockdale apartment was yielding nicely, and now he's gone for a commercial acquisition. And then he's moved into Mackay next. Yield on that.
I'm cautious of time here. I didn't realize we've already been an hour and 15 minutes.
Yeah. On a side note, I am bloody loving this, because I thought we weren't even going to talk about suburbs. I thought it was just going to be like property number 1, property number 2, behind.
Maybe we're getting too caught up.
There's a great comment here. Such a good live stream, boys. Absolute gold. Long-term investing and holding is key. Anyone else got some good insights that you're taking away from this? Because you guys are watching this along with us. What are you taking away? Go on, mate.
And I'll keep flying through. So he's got another commercial purchase. So 1820 in terms of the rental income. So another commercial purchase. This one's in Mackay.
Return. Crazy.
Then we've gone to Birkdale next. Where are we here? We've got a 1.4 purchase. This one here's a resi asset, 1.4 purchase, 1.6 current valuation.
Might be development site.
Compounding growth rate could well be. And then
and this is interesting. We're talking about those 3 pillars. Now I'm dragging on the time. Like, he's gone into Ballarat.
He's gone into Ballarat for a cheapie.
Yeah, wow. This guy's an enigma. Who is he? Just does whatever he wants.
Now he's adding a bit of negative cash flow into the portfolio. So again, this just could be opportunistic, right? Market sentiment. He's heard someone do it. It's got a bit of surplus borrowing or equity or whatever it is, and he's gone and bought another acquisition. But it looked like he was onto a yielding play after that, and then he's gone and added a property in a Ballarat there, a resi asset, relatively cheap compared to his most recent purchases. But in just in mindful looking at the time there, we've got the I didn't want borrowing capacity again in line with the income, so there and thereabouts. And it's
he can't buy anymore, essentially.
Can't buy anymore, but does he really need to? Is my question. We've got a portfolio value of 13.76 million. A really, really strong position. Higher debt here, so 5.7 mil of debt, $8 million worth of equity. A really, really, really strong position nonetheless. And if we come back through and we look at the income, so from a cash flow perspective, only producing $23,000 worth of passive income today. But if we come through and we look at all of the income coming through from this property portfolio, it's going to be really high. And there's no denying that. Correct. He's balanced it. He's basically replacing his income, and that's what he's aiming to do, right? So his portfolio income is almost where his salaried income is, 442 grand. His expenses are at almost 400 grand. Therefore, he's not producing that much cash flow. But that's what he was trying to do: work on the income side of thing, and then he's going to obviously work on the debt reduction next. So really strong income coming through from that.
That's
portfolio.
A really good takeaway, because I've been doing strategies now for 11 years or whatever it is. And I've actually found high income earners are desperate. They accumulate and then they're desperate to match their salary, because here's the secret. You don't get paid 500 grand a year without being a really high stressful job that has like a toll on your body, your lives, your marriage, et cetera, et cetera. And then they all have the shift out. I see it with specialist doctors, salespeople. Like, you can't just keep doing the 12-hour days. So they always shift into commercial or some form of cash flow.
Interesting.
And the last one that I've got for you guys, I've got Ned Flanders, right?
Okay.
So Ned Flanders here has...
Before we jump in, who is Ned Flanders? Give us the run through of Neddy, and then we'll...
Ned Flanders is a client who we've actually seen their portfolio develop, and now we've actually seen a drastic sell down in the portfolio. So Ned Flanders has 2 properties. One is their owner occupier in Bondi, and the other property is a commercial acquisition in Wollongong. That's not the actual address of it. Neither is that their owner occupier, but we can come in here and we can see they're in a $5 million owner occupier outright. So no debt against the owner occupier. Bought in 2015 for 2.7, now worth close enough to 5.
You're jumping ahead. Okay. Everyone load up your questions. We've got to wrap this thing up soon, and then we'll jump into the details of Ned Flanders' portfolio. Let's do that.
They said a savior would come, one who could see value where others saw fear, a buyer's agent who could turn data into destiny. Behold, Joe Tucker, an award-winning buyer's agent of Property Principal.
Whoa, what is this? Next thing you're going to see is driving off in our Lamborghinis, throwing cash about. You guys know Jeff and I, we don't really like to roll that way, right? We've been running this group for 5 years. We've been sharing all the data, all the strategies, all the tools, all the tips, all of the tricks that work in today's market to secure the best deals. But here's the thing though, if you're putting a part-time effort into something, you're going to get to a part-time result. And that's no difference with property, right? If you're dropping $500,000 to $1 million on property, this whole she'll be right attitude gets pretty expensive. What is the hardest part about building a portfolio? It really just comes down to time, knowledge, and execution. So if you don't have the time, you don't know what the heck you're doing, and you're afraid you're going to mess it up, then don't do it. That's literally why I do what I do. Most people don't even realize this, but I'm actually a buyer's agent. I run Property Principles Buyers Agency, and we have helped hundreds of investors get the right properties in the right locations so that they can scale their portfolio to $150,000 of passive income or more. Because why? Because we follow some core principles. We use a lot of data to pick the right locations. Think about it, the hot spots before there's ever heat. We get boots on the ground in every single location that we buy in. I have been there, checked it out, and approved the area. And we only buy in areas, and we only buy properties that we would want in our own portfolios. And that's how, in 2024, last year, we got a 21% growth across all of our client purchases, when the national average was 4.7%. For instance, Matt and Tina, a young couple, they bought 3 properties with us. They've built over $768,000 worth of equity, and they're still working full time. No dream selling here, but I tell you what, they're going to have a killer retirement. Phil, he's a young kid. He's just bought his first property with us. He's now on to his third, which is super exciting. He bought the first one, $595,000. That is now worth $770,000. He did a great little renovation up front. It's now grown $175,000. That's nearly 30% growth in under a year and a half. So it does take a little bit of time. Gosh, it does get there. Yes, we've had some big wins, but it's not an overnight get-rich-quick scheme. This whole property game is about smart, strategic decisions done well and taking the action. So I'm not here to sell you the dreams, but if you're ready, book in a discovery call. We can chat about what your next move is and if we can actually help. Let's do it.
New ad, yes, shorter.
Slightly shorter ad. Okay, let's cover off Nettie Flanders.
We'll fly through Ned Flanders. He's got an owner-occupier in Bondi that he owns, paid 2.7 for it. It's now worth $5 million, bought in 2015.
Zero loan on that.
$5 million. Zero loan on that. There was debt against it, but when he sold down his resi portfolio, he cleared the debt against that. And then he also bought this nice 7.2, or he paid $6.5 million and now has it's now worth around a 7.25 mil, and it's producing $11,250 per week in terms of income, generating over $550,000 worth of cash flow. Has one owner occupier.
He has zero loan on that.
He bought it outright, sold down his entire resi portfolio, had been investing for like a couple of decades, sold down the entire resi portfolio, cleared his owner-occupied debt, was goal number one, invested into the best possible commercial asset that he could with the surplus cash, and bought a $6.5 million property. It was actually in 2023.
Holy smokes. Steve, I want to ask you the question because you're the commercial king. Is that a good idea? Like in my mind, diversity.
It's a multi-tenanted asset. I should also add, it's not one tenant.
How do you think about that, Steve?
Yeah, so I was going to say it depends on what budget. Like he theoretically could have bought out like two good quality assets, but like Joey said, I envisage where this is probably like main strip, lots of foot traffic, or like multi-tenancy industrial. But I imagine it's probably like a big retail office, blah blah. So he's mitigating most of the risk that way. I imagine he knows the area really well. So I'm not against it. I personally would be able to, this is what I'm doing in my strategy, is probably leverage, go maybe buy 2 $5 million ones with a 30% debt on it. And then, yes, instead of having a 500 grand income now, he might only have a 300 or 350, but in then 10 years time, he's going to have a bigger one, and he's diversified across 2 assets and protected himself. But some people just also light the stick of dynamite and go, I'm done. And who are we to judge? He is doing way better than us.
True. Yeah, $500,000 worth of cash flow, and the owner occupier paid out in Bondi as well, might I add. It's a pretty nice position to be in. And this is even
if he drops the rent, this is the risk of not having debt. And like even with like my low debt, like he could theoretically tell all his tenants, oh, don't worry, World War III starting, just give me 50% rent, and he's still fine. House paid off, 250 grand income, happy days.
You would run out of things to buy. Like
I'm sure this person's having fun outside of work, Joe.
I don't think he has a job. I don't think he needs a job. I think Only so many golf balls.
Is
he
his
can
name
buy.
Jordan De Jong?
No, it is not. He wouldn't live in Bondi Beach.
That's true.
He'd be on the Gold Coast somewhere. But no,
So what was
gonna
his? Because you guys kind of saw the portfolio, but I don't know how that kind of looks like. But did you know what the portfolio looked like? Did it look like Ned or one of the other guys, or?
I didn't see the entire portfolio at its peak because he was always kind of selling some properties down. He really wanted to drive down the owner-occupied debt first, and then he sold the rest of his resi portfolio down. But it was similar-ish to your principal, not your principal Skinner, to your Mr. Burns. High income earner. He was high income. He wasn't quite the 460. He was probably more closer to the principal Skinner. So there's more like the 250 household income, a little bit more than that, but had been investing since the early 2000s as well. So this wasn't overnight. So he's not a younger dude. He's been doing this for 20 plus years, acquired those resi assets and then sold them down to clear the owner-occupied debt and then clear the rest of them to then go and fund the commercial acquisition outright in cash. And it's why I love seeing it. And you guys see it all the time where we actually speak to investors who are just starting their journey and we actually show them what a sophisticated and what a successful investor does to achieve their income goals. It doesn't need to be as drastic as that. And to Steve's point, it could be 2 by $3 million assets or 2 by $4 million assets or taking some debt out against them as well. But we actually see the people who have walked the walk as well. So when we are trying to speak to the younger investors, it's not just us saying we think this is going to work. It's actually proven methods of people who have been there and actually done that. And Steve, you're in a position yourself where you could theoretically go out there and do the same thing, right? If you wanted to drop the mic and run, so to speak. So that's the power of having seen so many of these portfolios and the insights that we can give some of the younger investors, or they don't even need to be a younger investor, just an investor who's on your way to trying to achieve similar outcomes.
I think the point I'm taking about, because like starting in the 2000s, he's been through, let's just say 3 growth cycles. My kind of light bulb moment was when you're talking about properties doubling, let's just say every 7 to 10 years, whatever. So he's in 3 growth cycles. When it goes through its first cycle, it doubles. When it goes through its next cycle, your property's quadrupled, not doubled, it quadrupled. When you go through the next one, it's
whatever that is,
whatever you call it. What's the 8 one? It's 8 times. Then this is why this guy's been able to do it, because he's been through the multiple cycles. Whereas the other ones who started in 2012 have missed that first cycle.
But I think that's a really good summary, right? All of these successful portfolios we've shown, and these are like the top 1% of the top 1%, are not like we did this overnight. These are people who have gone and they've stuck at it. This dude's gone through the GFCs, gone through recessions, gone through COVID, gone through 1,001 other turmoil events, and just stayed persistent and kept investing throughout, and now got themselves into a really nice position.
Property investing wasn't really a big thing in 2000. Like there was barely any books. What was it? The Jan Summers book, maybe, and maybe Margaret Lomas book, and that was pretty much it. That would have been what, 2008 or so, whenever it was.
So how did he? So I guess we can't look at the structure side of things, but like the structure, the way that they purchased it was growth up front, was the focus, is kind of what I got from that. It was buy good quality growth assets to get your equity. And then there was a consolidation period for some, but really it was to chuck a granny flat on to get the cash flow, do a commercial midway through to get that to help support the rest of the portfolio. Any other kind of structuring stuff that you guys saw from that?
I think that's awesome takeaway is like they've all put cash flow into it at some point. The last guy hasn't had to, because he's been in the cycle for so long with residential that he got to just, like I said, light the stick of dynamite and be like, boom, I'm done. But I think if you're now in this lending environment, he's also went through the awesome, easy lending environment where you go to the bank, equity, pull it out. Now that you have to layer in that cash flow at some point.
Well, yeah, maybe this is a perfect time to answer this question. Do you think building a portfolio in this decade with high interest rates is going to be more difficult than it was in the last decade? And I guess it's not necessarily interest rates, it's everything put together, the lending capacity. Like, how do you guys think about what this next decade is going to be? And can we do what these guys have just done?
Yeah, I personally think that my short answer would be yes. I think it is going to be difficult. There's no denying that obviously interest rates, as long as they stay as high as they are, it's obviously going to impact the ability to not only hold but also to scale portfolios. People may be potentially starting to reconsider the types of acquisitions in which they may be purchasing, or maybe exploring some value add, like we've mentioned throughout. I think that might become a bit of a flavor, like doing whatever we can to increase the rental income to minimize the holding cost on some of these assets. I think it is going to be difficult, but like there's never been a better time in terms of the amount of data, support, resource that are out there as well. Like think back to some of these investments that some of these clients would have made, that maybe they wouldn't have made the decisions, and maybe they could have had even better results if they had some of the data and assistance that is now at our fingertips today.
This is such a great point because like if we look at interest rates during March 2008, right, 7.25%. Some of these guys have lived through this, and then we've got 2011 4.5%, which is great. But then we still went through COVID, 4%, 4.3%. Now we're at 4.1% now. So it is a different market, but I also think that what these guys have done is not necessarily the same thing that you're going to do going forward. You're going to be able to buy assets that are a little bit different. Like one of the guys, I mean, he could have afforded more. I think it was Mr. Flanders or whatever. He bought a $300,000 property. Well, you might only be able to buy a $300,000 property or $350,000 property. So you will have to get a unit. Like if you want to get somewhere, you're going to have to do it. But also, we've been talking about average 12%, 13% growth. I bet anyone that bought over the last 2-3 years that has a portfolio will have 30% capital growth. Like, there you go. And these guys have made 7. So overall, when you average it out, even if it's not 20%, 30%, you've got this equity here that you have the ability to use. You just need to, buy the right assets so that you can.
Joey kind of glazed over the topic I want to point on. So I'd say it was easier for them to get lucky back then. It's way easier now. It's 1,000 times easier now to buy property. Like the invention of the internet and the data websites. You've got like
AI,
H-Tag, Stash, Suburb Finder. Like you can look at some really cool trends and do something outside the box. Like I did a video on like LGBT communities and how they grow compared to other ones. Like you couldn't do that 5 years ago. Like you can pull census data and correlate that with suburbs. Like now there's nothing stopping you. So you're actually making way more informed decisions. So I'd actually argue it is way easier now. Is the question, do you think we're going to be as lucky? Maybe not, but it's definitely easier now.
Yeah, to actually transact on a property and to make some informed decision. Yes, in terms of the scaling side of things, potentially not. Like it's obviously going to come down to policy, right? And where it was as easy as just going and pulling equity out and going again. Where that
I just think the beautiful thing is those two things align, like in the world, because it's harder and it's gotten easier to learn and get educated, and there's so many podcasts and stuff like that. And it's like, okay, cool. Well, those things kind of even each other out. And you can whinge and complain and say, "Oh my gosh, the baby boomers, they had it so well. Oh, why didn't you buy 6 at 180,000?"
Mm-hmm.
But it's like, cool. We now have the education. We now know that we are undersupplied as an Australian property market. What are you doing? Like, you can go out there and make this happen. It is going to take 10 years, and then take the equity out when you can get it. Do you have the cash? Yes. Do you have the borrowing ability and serviceability? Yes. Can I afford the cash flow? Yes. Okay, great. Go buy a property and stop wasting your time getting so bogged down with all these details, because it will be okay, because you've done the research. You're in a group like this. You use professionals like Steve, like myself, like Joey. Like that's how you're going to be able to beat the average.
When we talk about easier, one of the stories I tell. So my great grandfather couldn't afford a house in Australia, so he bought some land and built it on the weekends himself. So did he have an easier run? Probably not. He spent his weekends building the house. Then my grandfather probably had a good one. He bought a house in Bondi, and awesome buy back then in the 70s, whenever it was, did really, really well. My dad then couldn't afford Bondi because it was 35 grand. So my dad was like, can't afford there. I'm going to buy Wentworthville, which is shithole Sydney's West where I grew up kind of thing. No offense to the Wenny people. For 30 grand, and then had to buy that. And then I couldn't afford even Wentworthville, so I went Blacktown. I went a housing commission house in Blacktown. So where is this easy part? Like they just stuck it out for longer.
That's a good point. That's a good point. Any other key points to hit on this, Joey? These are meant to be an hour. We've gone an hour and a half, so I apologize. People are here. People are getting value out of it. This has been an incredible session. Any other things that you wanted to? Any other points to hit on that we haven't covered off?
Give the listeners like takeaways, the things you see from game plans, because you do strategies all day, every day, like little hints and tips, trends that you see, like this, what the majority of people get right and wrong.
Yeah, I suppose it's actually thinking the next step ahead. So like what we said before, if you had X amount of capacity, actually stress test what it looks like if you were to go and capitalize on all of that, or if you were to make a smaller purchase, keep some capacity and make another acquisition next year or the year after type of thing, rather than going and blowing it all on one property and consuming all of the cash flow. Get really diligent in and around your numbers, because I personally think coming into where things are right now in the interest rate environment and whatnot, that cash flow is going to become really important. So really understand your numbers, not to say that we need to be buying cash flow positive, but understanding your cash flows is going to be really important. I still think that growth is going to be the fundamental driver that's going to allow you to potentially get into that next acquisition quicker. But there's just going to be a little bit more emphasis in terms of your numbers and making sure that you understand them so that you can afford to hold and you can afford to get into that next property. I would also like just stay persistent, actually stay at it. If there was one thing that I could take away from these portfolios that I've demonstrated, is that none of them got rich quick overnight, or none of them built the portfolios that they've built overnight. Some of them have sure done very well post-COVID, but the vast majority of them have been just kind of investing, sticking at it. When they had the capacity to go again, they went again. If they've got the ability, the desire, and the hunger to add value, they added value to help keep them in the game and help them get into that next acquisition even quicker as well.
Yeah, they just kept going. They just kept chugging along.
Yep.
Yeah, they didn't crush it. That's one point that I'm taking away. They didn't absolutely knock the lights out like you guys have the ability to do when you buy a property with the amount of data that we've got access to be able to cherry pick the top 1% suburbs by doing it correctly. I just want to stay on this one and go through more of the data, but we do have to wrap this sucker up. Joey,
we can do round two. We can do round two.
Thank you so much. Steve Polisi from Polisi Property, amazing commercial property buyer's agent. When it comes to that next phase of needing that cash flow, hit that man up, check him out, read the books. Joey, what do you want to promote? Because Game Plans is an amazing platform, but it's not necessarily, you kind of have to go through buyer's agents to be able to get it. So what do you want to promote?
Just tell me to promote property principles and Polisi Property. That's all you got to do.
Yeah, I'm happy with that. You guys are part of the Game Plans. That works for us, right? Your success is our success. No, I just want to promote really good education within the space and putting property strategy at the forefront. And if people think of property strategy and can think of game plans, that's a win for us.
Yeah, 100%. The way I like to think about it is, what does this next property need to be to allow me to get into the next one? And Game Plans allows me to know I'm here, I want to get here, and it's bloody possible. If I do, this, and this, I'll get there. But all I need to do, 1 foot in front of the other, 1 foot in front of the other. What does this one need to be? Does it screw me over for the next one? No, great, let's go again. And then you'll hit a wall. Great, I'm going to get screwed over by my cash or equity, borrowing ability or serviceability, or the Steve Polisi cash flow. Cool, I'm getting hit with cash flow too much. What do I need to do? I need to inject a new cash flow asset to balance out one of those three things. This stuff, it's not complicated. Joey, you broke it down incredibly well. Steve, you were an amazing co-host. Anything you want to leave with us, mate?
I'd say Jeff's mentioned Joey and Jordo have a podcast, so plug that.
Oh, that's very good. I'm coming on that. Yeah.
If you want a podcast based on strategy,
what's the podcast called?
What better than Game Plans?
The Property Strategy Podcast. You can find us on most, if not all, major platforms: Spotify, YouTube, Apple, and the like. So give that a listen and 5 stars review, please.
How did you come up with that name?
The Property Strategy Podcast?
Yeah.
I just basically said, what do we want to talk about? We want to talk about property strategy. Well, then there's your name. We actually had a debate about whether we should include the in there or not, or just go, Jordan wanted to do Property Strategy Podcast. And I was like, nah, I think the Property Strategy Podcast. No. So anyway, that's
like
the name of
the
podcast.
Facebook all over again.
The Facebook.
Check out the podcast. See you guys.
Thanks,
Thank you very much.